Before we begin today's analysis, a brief word. If you value thoughtful, disciplined perspectives on precious metals and financial markets, insights grounded in history, data, and rational strategy rather than noise, consider subscribing to this channel. We're building a community of serious investors who understand that wealth is built through patience, preparation, and clear thinking. Not hype, not promises. Just calm, professional guidance when the markets demand your attention. Now, let's talk about what's happening right now in silver and gold. Something is shifting beneath the surface of precious metals markets. While most investors remain fixated on stock indices and headlines, a quiet transformation is taking place in silver and gold, one that carries significant implications for portfolio positioning, wealth preservation, and strategic opportunity. This isn't about panic. It isn't about wild speculation. This is about recognizing when market conditions are changing and responding with intelligence and discipline. Gold is consolidating near historic highs, showing technical patterns that have historically preceded major breakouts. Silver, meanwhile, is displaying unusual behavior, price action that suggests accumulation, divergence from its typical patterns, and a potential awakening from years of relative dormancy. Why does this matter to you? Because these metals don't move in isolation. They respond to monetary policy, currency devaluation, geopolitical instability, and most importantly, shifting investor psychology. When both metals begin signaling simultaneously, experienced investors pay attention. Today, we're going to examine exactly what's happening, why it's happening, and what you should be thinking about, whether you already hold precious metals or you're considering your first position. This is a conversation about strategy and about risk management, about understanding market cycles before they become obvious to everyone else. Let's begin with clarity. Gold has reached levels that most analysts considered impossible just a few years ago, but price alone tells us nothing. What matters is how it got here and what the structure of this advance reveals. Look at the chart behavior over the past 18 months. Gold has been building what technical analysts call a consolidation pattern, a period where price moves sideways or in a tight range after a significant advance. This isn't weakness. This is digestion. This is the market absorbing supply, building a foundation, preparing for what comes next. Historically, when gold consolidates at or near all-time highs while maintaining price support, it's often a precursor to another leg higher. Not always, but often enough that dismissing the pattern would be careless. Silver is more volatile than gold, more industrial in nature, more sensitive to economic cycles, and right now it's showing something unusual. For years, silver has underperformed gold on a relative basis. The gold to silver ratio, the number of ounces of silver needed to buy 1 ounce of gold, has been elevated, sitting well above its long-term historical average. But recently, silver has begun to stir. Small moves at first, nothing dramatic. But the character of the price action has changed. There's absorption happening, large volume days without significant price declines, resilience during broader market weakness. This is the kind of setup that precedes momentum shifts. Not guaranteed, but worth watching closely. Gold and silver don't always move in perfect synchronization, but when they both show constructive patterns simultaneously, it amplifies the signal. Gold tells you about monetary confidence, central bank policy, and long-term wealth preservation. Silver tells you about industrial demand, inflation expectations, and retail investor sentiment. When both are flashing similar signals, you're looking at a confluence, a moment where multiple factors align. These moments don't come frequently, and they don't last forever. Let's talk about the environment that makes precious metals relevant. Central banks around the world have engaged in unprecedented monetary expansion over the past 15 years. Quantitative easing, emergency lending facilities, direct debt monetization. The playbook has been deployed repeatedly. What does this mean for you? It means currency devaluation. Not the kind you see in overnight crashes, but the slow, steady erosion of purchasing power that compounds over time. Your cash buys less. Your savings lose ground to inflation. Your fixed income investments struggle to keep pace. Gold and silver have historically served as hedges against this erosion. Not perfect hedges, not guarantees, but stores of value that tend to preserve purchasing power when fiat currencies weaken. Right now, with deficits expanding, debt levels at historic highs, and political will for fiscal discipline virtually non-existent, the case for holding some precious metals allocation remains compelling. The world is fracturing. Trade relationships are being renegotiated, alliances are being questioned, deglobalization is accelerating. These aren't predictions. These are observable trends already in motion. In fragmented geopolitical environments, nations seek monetary independence. They diversify away from dominant reserve currencies. They accumulate hard assets, particularly gold. Central bank gold buying has been robust for several consecutive years, with emerging market central banks leading the charge. This isn't speculation by retail investors. This is official sector accumulation by institutions that think in decades, not quarters. When central banks accumulate an asset consistently, year after year, it tells you something about long-term value and strategic importance. Inflation has moderated from its recent peaks, but the conversation about inflation is far from over. Structural factors, aging demographics, deglobalization, energy transition costs, defense spending increases, all point toward a higher inflation regime than what prevailed during the 2010s. Even moderate inflation, sustained over time, destroys wealth. A 3% inflation rate cuts purchasing power in half in roughly 23 years. A 4% rate does it in 18 years. Precious metals won't protect you from every inflation scenario, but they tend to perform well when inflation proves stickier than consensus expects, or when monetary authorities lose credibility in their inflation-fighting efforts. We're not predicting hyperinflation. We're not forecasting currency collapse. We're simply acknowledging that the balance of risks has shifted, and prudent investors adjust their positioning accordingly. Precious metals move in long cycles, often measured in years, sometimes in decades. The last major bull market in gold and silver ran from roughly 2001 to 2011. Gold went from under $300 per ounce to over $900. Silver went from under $5 to nearly $50. Both metals then entered multi-year bear markets, eventually bottoming around 2015-2016. What did that cycle teach us? First, these moves take time to develop. They don't happen in straight lines. There are corrections, consolidations, periods of doubt and frustration. Second, the early stages are characterized by disbelief. Most investors don't participate until the move is well underway. They wait for confirmation, which often means buying at higher prices. Third, the final stages are characterized by euphoria. Everyone becomes interested. Mainstream media runs breathless coverage. Retail investors pile in at precisely the wrong time. Where are we now in the cycle? Based on price structure, sentiment indicators, and positioning data, we appear to be in the middle innings, past the early accumulation phase, but well before the euphoria stage. Gold has made new highs, which is significant. But silver hasn't yet broken out to new highs. The gold to silver ratio remains elevated. Retail investor interest in precious metals is moderate, not extreme. These are characteristics of a bull market that still has room to run, not one that's exhausted. Compare today's sentiment to 2011. Back then, everyone was talking about gold. Coin dealers couldn't keep inventory. Cash for gold shops appeared on every corner. That was euphoria. Today's market is different. There's interest, yes, but there's also skepticism, doubt, and plenty of investors who remain underweight or entirely absent from precious metals. That's actually constructive. It means the crowd hasn't arrived yet. When gold consolidates near highs and then breaks out, the subsequent moves have historically been significant. We saw this pattern in the early 2000s. We saw it again in 2019-2020. In both cases, the breakout led to sustained advances that lasted months, not days. Silver tends to lag initially, but then accelerates once momentum builds. The silver move is often shorter in duration, but more explosive in magnitude. It requires patience, but rewards those who position early. Understanding these historical patterns doesn't guarantee future performance, but it provides context. It helps you maintain composure during volatility. It prevents you from making emotional decisions based on short-term noise. Let's talk about psychology, because technical patterns and fundamental factors mean nothing if you can't control your emotional response. Most investors miss significant moves in precious metals for predictable reasons. They wait for confirmation. They want to see the breakout first, the momentum established, the mainstream recognition. By that time, they're buying at elevated prices and setting themselves up for disappointment if a correction follows. They overtrade. They try to catch every swing, time every entry, and exit perfectly. They trade based on hourly charts and daily noise. They burn themselves out and often exit positions at exactly the wrong time. They lack conviction. They haven't done the work to understand why they own precious metals. So when the price drops 10%, they panic and sell. When it rises 10%, they take profits and miss the bigger move. Successful precious metals, investing requires a different mindset than stock trading. You're not looking for quarterly earnings beats. You're not analyzing revenue growth or margin expansion. You're positioning for long-term monetary trends, protecting purchasing power, and potentially capturing cyclical moves that unfold over years. This requires patience. It requires accepting volatility without reacting emotionally. It requires sizing your positions appropriately so that price fluctuations don't cause psychological distress. If you can't handle seeing your silver position drop 15% during a correction without panicking, your position size is too large. If you're checking prices multiple times per day and feeling anxious, you're not thinking long-term enough. When everyone becomes interested in precious metals, that's often a warning sign, not a buying opportunity. When your friends who never discuss investing start asking about gold, when mainstream financial media runs fawning coverage, when new investors flood into the space, these are signs of late cycle behavior. Conversely, when precious metals are ignored, when mainstream analysts dismiss them as relics, when sentiment is poor, that's often when the foundations for the next move are being built. Right now, we're somewhere in between. There's growing interest, but not mania. There's recognition, but not euphoria. That's a constructive setup for patient investors. This section is for those who already own gold, silver, or both. You've made the decision to allocate capital to precious metals. Now what? Just because you own precious metals doesn't mean your work is done. Position sizing matters. If precious metals represent 2% of your portfolio, a significant move might barely move your overall wealth. If they represent 40%, you may be taking unnecessary concentration risk. Most financial advisors suggest precious metals allocations between 5% and 15% of investable assets, depending on individual circumstances, risk tolerance, and overall portfolio construction. There's no magic number, but there are thoughtless extremes on both ends. Review your allocation periodically. As prices move, your allocation shifts. If gold has doubled while your stocks have remained flat, your precious metals allocation may now be significantly higher than intended. That might be fine, or it might require rebalancing. If you own physical metals, coins, bars, stored bullion, you have direct ownership and no counterparty risk. That's valuable. But physical metals don't provide income, aren't easily divisible for small transactions, and require secure storage. If you own precious metals through ETFs, mining stocks, or futures contracts, you have liquidity and ease of trading. But you also have counterparty risk, management fees, and tracking errors. Both approaches have merit. Many sophisticated investors use a combination: physical holdings for core, long-term insurance positions, and paper instruments for tactical exposure or trading around core positions. What matters most is understanding what you own and why you own it. Don't hold a gold ETF thinking you can retrieve physical metal in a crisis. Most ETFs don't work that way. Don't buy physical gold thinking you can sell it instantly at spot price. Dealers charge premiums and have bid-ask spreads. You've established a position. Now comes the hard part, leaving it alone. If your thesis is long-term monetary debasement and cyclical precious metals appreciation, why would you trade in and out based on weekly price action? Yet many investors do exactly this. They see a 5% gain and take profits. They see a 5% loss and panic sell. They're constantly repositioning, second-guessing, and generating transaction costs. This behavior destroys returns. It creates tax liabilities. It causes you to miss the moves you were trying to capture in the first place. If your conviction level doesn't support a buy and hold approach, your position size is probably too large, or your understanding of your own investment thesis needs work. There may be opportunities to add to your precious metals allocation, but they should be approached strategically, not impulsively. Adding during corrections, when sentiment is poor and prices have pulled back, is generally smarter than chasing breakouts, but even this requires discipline. How much of a correction? How do you define the entry point? What prevents you from freezing if prices drop further? One approach: dollar cost averaging over time, regardless of price. This removes emotion from the equation and ensures you're consistently adding to positions according to a predetermined schedule. Another approach: predetermined price levels or technical signals. If gold pulls back to a specific support level, you add a specific amount. No emotion, no improvisation, just execution of a plan. What doesn't work: adding when you feel most excited, when momentum is strongest, when everyone is talking about precious metals. That's when you're likely paying peak prices. This section is for those who don't currently own precious metals, but are considering establishing a position. What should you be thinking about? Before you buy a single ounce of metal, ask yourself why. Are you hedging against currency devaluation, diversifying your portfolio, speculating on a cyclical trade, preparing for potential economic instability? All of the above? Your answer determines how much you should allocate, what form your exposure should take, and how long you should plan to hold. If you're hedging, think in years or decades. Small, consistent allocations. Physical metal or highly liquid ETFs. No leverage. No attempt to time entries perfectly. If you're seeking tactical exposure to a cyclical move, your time frame is shorter. You might use mining stocks for leverage to metal prices. You'll need to be more active in monitoring positions. Your risk tolerance needs to be higher. Most investors should think more like hedgers and less like traders. Everyone wants to buy at the perfect entry point. This is understandable, but often counterproductive. Waiting for the perfect entry means you're likely to wait forever, or enter, after a significant move has already occurred. Markets don't cooperate with our desire for perfect timing. A more rational approach: start with a small position now. Establish a presence in the asset class, then add systematically over time or on weakness. This approach ensures you participate if prices move significantly higher from current levels, while also giving you the flexibility to add if prices correct. It's not perfect. No strategy is. But it's psychologically manageable and historically effective. Precious metals are volatile. Silver especially can swing 5% in a day on no particular news. If that level of volatility causes you stress, anxiety, or sleepless nights, you need to adjust your position size. There's no valor in holding a large position that makes you miserable. There's no shame in starting small and gradually increasing exposure as you become comfortable with the asset class. Risk tolerance isn't just about potential losses, it's about emotional capacity to stay rational during volatility. Many investors can theoretically handle a 20% drawdown, but in practice, panic and sell at the worst possible time. Be honest with yourself about your temperament. Size your positions accordingly. Within precious metals, you have choices: gold, silver, platinum, palladium, mining stocks, streaming companies, physical or paper. For most investors, gold and silver are the primary choices. Gold is more stable, more liquid, more universally recognized. Silver is more volatile, more industrial, potentially more leveraged to economic cycles. A combination of both often makes sense. Perhaps 60-70% in gold and 30-40% in silver, adjusted based on personal views and risk tolerance. Mining stocks offer leverage to metal prices, but come with operational risks, management risk, and equity market correlation. They're not a substitute for metal ownership. They're a different asset class entirely. New investors should start simple, physical metal or highly liquid ETFs. Build understanding before adding complexity. Let's address the behavioral errors that destroy returns and create unnecessary stress. These mistakes are common, predictable, and entirely avoidable. Trading based on fear or greed is the fastest way to underperform. When prices are rising and momentum is strong, greed makes you chase. You enter at elevated prices, convinced the move will continue indefinitely. Then the correction comes and you're underwater. When prices are falling and sentiment is negative, fear makes you sell. You exit positions at or near the bottom, locking in losses. Then the rebound begins and you're on the sidelines. Both impulses feel right in the moment but produce terrible results over time. The solution: make decisions based on your investment thesis, not your emotional state. Have a plan. Follow the plan. Adjust the plan only when facts change, not when feelings change. Leverage amplifies returns. It also amplifies losses and forces you into situations where you can be right about the direction but still lose money due to timing. Using margin, options, or leveraged ETFs to gain precious metals exposure might feel like a smart way to maximize returns. In reality, it's usually a path to forced liquidations, margin calls, and significant losses. Precious metals are volatile enough without adding leverage. The cyclical moves can take years to play out, with substantial corrections along the way. Leverage turns these corrections into catastrophes. If you can't achieve your goals with unleveraged exposure, the problem isn't insufficient leverage, it's unrealistic expectations. No one consistently times market entries and exits perfectly. Not professional traders, not institutional investors, not you. Trying to do so leads to paralysis. You wait for the perfect entry point that never arrives. Or it leads to overtrading. You're constantly jumping in and out, generating costs, and usually getting the timing wrong. Better approach: time zones rather than exact points. Enter when valuations seem reasonable and your investment thesis is intact. Add on weakness if you have available capital and your thesis hasn't changed. Hold through normal volatility. You'll never buy the exact bottom or sell the exact top, but you can participate in the meaningful portion of the move with far less stress and far better results. Even the right asset at the right time becomes the wrong investment if your position size is inappropriate. Too small, and the position doesn't materially impact your wealth even if you're completely correct. Too large, and the volatility becomes psychologically unbearable, forcing you to exit prematurely. Most investors err toward positions that are too large relative to their risk tolerance. They want maximum exposure to potential gains, not realizing they're setting themselves up for maximum emotional distress during inevitable volatility. Start smaller than feels exciting. Increase gradually as conviction and comfort grow. This approach is boring but effective. Mistake 5: following the crowd. When precious metals become the topic of dinner party conversations and social media trends, be cautious. Widespread enthusiasm often marks late-stage moves, not early opportunities. The time to be interested in precious metals is when no one else is, when sentiment is poor, prices have corrected, and mainstream attention has moved elsewhere. Conversely, when you feel most doubtful about your precious metals holdings, when prices are weak, sentiment is negative, and pundits are declaring the bull market dead, that's often when you should be most convicted. This is counterintuitive. It feels wrong. That's precisely why most investors get it backwards. Precious metals are one asset class among many. They serve specific purposes: inflation hedge, portfolio diversification, potential cyclical returns, monetary insurance. They're not a substitute for a complete financial plan. They don't generate cash flow. They don't participate in productive economic growth the way businesses do. Some investors become so focused on gold and silver that they neglect stocks, bonds, real estate, and cash. This creates concentration risk and often leads to worse overall portfolio outcomes. Precious metals should enhance your portfolio, not dominate it. There's something psychologically satisfying about holding physical gold or silver. The weight, the tangibility, the sense of security. But don't confuse this psychological benefit with investment performance. Physical metal requires secure storage, insurance in some cases, and involves higher transaction costs when buying and selling. For many investors, a combination of physical metal for psychological comfort and paper instruments for liquidity and cost effectiveness makes sense. But this should be a conscious decision, not an emotional one. Start with your overall financial situation. What percentage of your investable assets should be in precious metals? For most investors, 5 to 10% is a reasonable baseline. Conservative investors, or those who primarily seek diversification, might stay at the lower end. More aggressive investors, or those with strong conviction about monetary trends, might go higher. Above 15%, you're making a significant directional bet. That might be appropriate for some, but it requires strong conviction and the temperament to handle significant volatility. Physical bullion, maximum security, no counterparty risk, but higher transaction costs and storage considerations. Best for long-term holdings you don't plan to trade. ETFs, high liquidity, low costs, easy to buy and sell. But they're financial instruments, not physical ownership. Consider established funds with high assets under management and tight bid-ask spreads. Mining stocks, leveraged to metal prices, but with operational and equity market risks. More suitable for investors who want active exposure and can handle higher volatility. Most balanced approach for beginners. Core position in physical metal or highly liquid ETFs, with potentially a smaller allocation to mining stocks if your risk tolerance supports it. Don't try to invest your entire intended allocation in a single transaction. Consider building over 3 to 6 months, especially if you're investing a significant amount. This gives you multiple entry points and reduces the risk of poor timing. Alternatively, commit to regular purchases on a fixed schedule, monthly or quarterly, regardless of price. This is dollar cost averaging, and while it won't optimize your entry point, it removes emotion from the process. If you're buying physical metal, think through storage before you purchase. Home storage gives you immediate access, but creates security risks, requires a quality safe, appropriate insurance, and discretion about what you own. Bank safety deposit box, more secure than home storage for most people, though accessibility is limited to bank hours. Private vault storage, allocated, segregated storage through reputable companies, higher fees, but professional security and insurance. Each approach has trade-offs. Your choice depends on the amount of metal you own, your security situation, and your comfort level. You should be aware of significant developments in precious metals markets, but you don't need to track prices daily. Set a schedule, weekly or monthly, to review your precious metals allocation. Check that it still aligns with your target allocation. Read relevant analysis occasionally, but resist the urge to check prices constantly. Frequent monitoring encourages frequent trading, which usually produces inferior results. The signals we're seeing in gold and silver don't exist in a vacuum. They tell us something about broader financial market dynamics. When gold and silver show strength, they're often reflecting underlying concerns about monetary policy, currency stability, or economic resilience. These concerns might not be mainstream yet. Markets often signal problems before they become obvious. Gold and silver can act as early warning systems for monetary or confidence issues. Pay attention to these signals, but don't overreact. Markets can remain stable for extended periods while precious metals appreciate. It's not necessarily predicting immediate crisis. It's reflecting gradual shifts in fundamentals and sentiment. Strength in precious metals often coincides with questions about currency value, though the relationship isn't always straightforward. In a world where all major currencies are being debased to some degree, gold and silver represent alternatives, stores of value that can't be printed or digitally created. This doesn't mean fiat currencies are about to collapse. It means the balance between fiat money and hard assets is shifting at the margin, and investors are adjusting their portfolios accordingly. Conventional wisdom says higher interest rates are negative for precious metals because they increase the opportunity cost of holding non-yielding assets. But this relationship is more nuanced than commonly understood. If interest rates rise because inflation is accelerating, precious metals often perform well despite higher rates. If rates rise because growth is strengthening in a low inflation environment, metals may indeed struggle. Context matters more than the direction of rates alone. What matters most for precious metals is real interest rates, nominal rates minus inflation. When real rates are negative, meaning inflation exceeds the yield you can earn on cash or short-term bonds, precious metals become more attractive. You're losing purchasing power in cash, so the opportunity cost of holding metals is reduced. Currently, real rates remain a topic of debate. Official inflation figures show moderation, but many investors question whether these figures capture the true erosion of purchasing power they experience. This skepticism about official data supports precious metals demand. We're approaching the end of our discussion. And let's bring this together with some final perspectives on discipline, preparedness, and the right mindset. If you're approaching precious metals as a get-rich-quick scheme, you're setting yourself up for disappointment and poor decisions. Precious metals are about wealth preservation first, potential appreciation second. They're about portfolio diversification and monetary insurance. They're about having assets that behave differently than stocks and bonds during certain market environments. Yes, there are cyclical bull markets where significant gains are possible, but these take time to develop and require patience to capture. Most of the return comes from holding through volatility, not trading in and out. Set appropriate expectations. This adjustment alone will improve your results dramatically. The goal isn't to predict exactly what happens next in markets or economics. The goal is to position your portfolio so that you can weather various scenarios. Precious metals allocation is one component of a resilient portfolio. It's insurance against certain outcomes: prolonged inflation, currency instability, geopolitical instability, loss of confidence in monetary authorities. You don't buy insurance hoping to collect. You buy it for peace of mind and protection if things go wrong. View some portion of your precious metals allocation through this lens. More money is lost to impatience than to almost any other factor in investing. Impatience makes you trade too frequently. Chase performance. Abandon strategies before they have time to work. Capitulate at bottoms. Get overly excited at tops. Successful precious metals investing requires a different tempo than what most modern investors are accustomed to. It requires thinking in years, not months. Measuring success by whether you were positioned correctly for the macro environment, not whether you caught every short-term swing. This discipline is difficult but essential. Your ability to control your emotional response to volatility matters more than your ability to analyze charts or predict economic data. Two investors can have identical positions, but if one panics during corrections while the other maintains composure, their results will be dramatically different. Build emotional stability by understanding your investment thesis deeply, by sizing positions appropriately, by having a plan and trusting that plan during uncertainty. When prices drop sharply, ask yourself, has my thesis changed? Has the long-term case for precious metals deteriorated? Or is this just normal volatility in a volatile asset class? Usually, it's the latter. Emotional stability allows you to hold through these periods and capture the long-term returns you invested for. Markets evolve, monetary systems change, geopolitical dynamics shift. Your understanding should evolve with them. Stay informed about central bank policy, fiscal trends, currency markets, and precious metals supply and demand fundamentals. But don't become obsessed. There's a difference between staying informed and drowning in noise. Read quality analysis from diverse perspectives. Understand the bull case and the bear case. Be willing to adjust your views when facts change. Intellectual humility combined with firm principles produces better results than rigid ideology. Step back for a moment and consider the truly long-term perspective. Throughout history, civilizations have experimented with various forms of money. Fiat currencies come and go, governments overspend and debase their currencies, economic systems rise and fall. Through all of this, gold and silver have maintained value. Not because they're perfect money, not because they're ideal investments, but because they're scarce, durable, divisible, and universally recognized. This history doesn't guarantee future performance, but it provides context. It suggests that having some allocation to precious metals is a rational long-term decision, regardless of short-term price movements. If you're an existing precious metals holder, review your allocation, ensure it still aligns with your goals, resist the urge to overtrade, stay disciplined. If you're considering establishing a position, start with education. Understand why you're investing before you invest. Begin with a small, manageable position. Build over time as conviction grows. If you're skeptical of precious metals, that's fine. But stay intellectually honest. Understand the counter-arguments to your skepticism. Remain open to changing your view if circumstances change. This might sound harsh, but it's liberating when you truly accept it. The market will do what the market does. Gold and silver will be volatile. There will be corrections that feel frightening. There will be rallies that feel exciting. There will be long periods where nothing much happens. None of this has anything to do with what you want or how you feel. Your feelings are not a useful input for investment decisions. Your analysis and your discipline are. When you separate your emotional state from your investment decisions, you gain an enormous advantage over investors who can't make this separation. The signals we're seeing in gold and silver suggest that something significant may be developing. Not a guarantee, not a promise, but a setup that deserves attention from serious investors. Whether these signals lead to a major breakout or a false start, your response should be grounded in discipline, not emotion, in strategy, not speculation, in long-term thinking, not short-term impulse. This is how wealth is built and preserved, not through perfect timing or lucky trades, but through consistent adherence to rational principles over time. The warning signs are there. The patterns are forming. The macro backdrop supports precious metals allocation. What you do with this information is up to you. But whatever you decide thoughtfully. Act deliberately. And once you've acted, have the discipline to let your strategy work. Markets reward patience, punish impulsiveness, and ultimately vindicate those who approach investing as a long-term discipline rather than a short-term game. The choice, as always, is yours.